All right, everybody. Happy Sunday. This is the Sunday Focus List video, so let's get jumping right in. So, when it comes to trading, that is what we talk about here. When it comes to trading successfully, a huge component is respecting the current environment. So, in certain environments, there are kinds of setups and strategies that are going to thrive, but once the environment changes, those same strategies and setups can literally tear your account apart. So, as far as the environment right now, what has changed over the last handful of weeks is the volatility spike. So we have gone from a low volatility environment, and this is key. The low volatility environments, which is basically anytime we're under that 21, when we're looking at VIX, there are certain trades that are going to work perfectly. So finding that daily squeeze, that weekly squeeze, or any squeeze, and just looking for that clean directional move, that works perfect in a low volatility environment. Once VIX begins to spike here, unfortunately, a lot of that crap goes out the window, where once volatility is spiking, you can find the best looking setup in the market. Something like a DraftKings had a perfect squeeze, it had everything. It's going to get impacted by the volatility. So as a swing trader, there's a time and a place to look for, say, a Google. Google could not look any better right now. Arguably one of the best looking setups in the entire market. Daily squeeze, unlike Amazon, Facebook, and the other tech stocks, holds up beautifully last week above the 21, stacked EMAs, green 10x bars on the weekly, the 3-day, the daily. It's picture perfect. This is the kind of setup where you have a huge probability of banking a profitable trade when the market is not going through high volatility. Once that volatility spikes, regardless of how good the structure is here, it can certainly fall victim to the overall market. So that's the major thing to keep in mind right now. You might find a Google, which I would agree with you, looks beautiful. Eli Lilly looks beautiful. There's plenty of setups that still look super solid out here, but it's just the acceptance that, man, if the market doesn't get it together here and we just keep grinding lower and we keep grinding lower, how long is something like a Google going to buck the trend? It's pretty unlikely. Now, from another point of view, if the indexes kind of get back on their own 2 feet, and we see volatility die back down, and we do into April, into May, see the indexes back towards new highs, then you know what? A setup like Google is probably going to be one of the first to lead you towards a profitable trade. But those are things we can't answer quite yet. So a huge component to keeping your head above water right now is practicing patience and waiting on the environment to change. So for those daily squeezes, those good clean setups to have a good probability of firing long, we need to see VIX back under the 21. I think a good rule you should have in place here is that as long as the volatility index is above its 21 EMA, expect more downside for the market. And then just kind of, the realization that, if there's more potential for the market to go lower, is Google really going to buck the trend and just go on this insane move? Hey, maybe. I think's a little bit unlikely. So, Friday when the market closes, or going into the close rather, you get the big decline for VIX, you get the big pop for the indexes. So that does look pretty good as we head into the new week, but we ain't out of harm's way just yet. So once VIX is consistently trading back under the 21 and see the bullish momentum on the histogram, we got to see that disappearing. So once we're back under the 21 and once you got rid of the bullish momentum, the Googles, the Eli Lillys, those picture perfect, beautiful squeezes, hey, they should have all the chance in the world of making that move you're looking for. But until then, they're at risk here of, while they look picture perfect, they might just kind of, completely fall apart if the markets keep going lower. So when we're in the high volatility environment, what can tend to work a little bit better than catching those good clean squeezes is just focusing on shorter term swings, playing the reversion to the mean game. So if we get the Keltner channels up here, until VIX dies and until the indexes are back above their 21, this is the game to expect. We're going to push 2 to 3 ATR to the downside, and then we probably rip right back to the 21. Then we make another leg to the downside, and we probably going back home. Continue to fail to close above it. We fail to close above it, right back down. So now at this point, heading into the new week here, would I want to be short tech stocks over the weekend? Hell no. Now, we might gap down, and that's the perfect trade. But you got to think in terms of probabilities. For the very same reasons, you're not going to most likely, have a successful long career as a trader. Getting long at 2+ ATR, for the same reasons there, you're probably not going to have a long successful career trying to go short 2 to 3 ATR to the downside. So within these kind of ebbs and flows here, there is opportunity. And we had a heck of a week last week in the simpler room, taking advantage of those opportunities, selling put credit spreads on Google once we're extended, profiting on the move back up, shorting the index, shorting Amazon once we get rejected at the 21, profiting on the move back down. So 2 completely different styles of trading. And believe me, my favorite trade in the world is when we're in a low volatility environment. The market is just grinding higher. You have yourself a total dime piece, like this Google squeeze here, and I sell my put credit spread, and then I kind of wander off into the sunset, only to return a few weeks later collecting some premium. That's a fun game. It's a game that can get you crushed in a high volatility environment. So I typically like to come to y'all and offer some suggestions for setups, and I will give you Google, which I think looks phenomenal. But this isn't about Google. It's about the overall market environment. VIX continues to go higher. The indexes continue to go lower. Google probably got a pretty tough chance here of bucking that entire trend. So Google becomes the best looking setup in the market to me once the indexes find a bottom and once VIX is back under the 21. So I love the idea here of, this is a good setup. I'm going to come in here. I'm going to go to April expiration. I'm going to sell some poor sucker out there. Put it 250. I'm going to buy one at 240. And I'm going to get my 2-to-1 risk reward ratio, put credit spread, and just disappear. I love those. Not right now. Not until the bigger picture changes. So in the meantime, it is going to be more of that kind of back and forth reversion to the mean kind of trading. Eli Lilly. I mean, we can't make any kind of complaints about the structure of the setup here. Stacked moving averages, green 10x everything. Awesome looking tight compression squeeze above the 21. Picture perfect. But if VIX keeps spiking and the markets keep rolling over, is this going to buck the entire trend? Maybe, but I'm thinking in terms of probabilities. So all of this to say, be patient. Just be patient. I mean, the market ended pretty good last week, but be patient, y'all. So weekly charts, S&P 500. This is why I love the weekly. You tune out motion and all the crap from the Monday through Friday, and you get a clear picture of the market. The weekly chart here is telling me you are in one hell of an uptrend. Stacked moving averages, green 10x bars. We barely even tested the 21 this week, and we closed above the 8. So I ain't saying there's not more downside to come. I'm just saying that if you tune out that noise and look at a weekly chart, this looks rock solid. The Qs. Now, the Qs were catching the spanking this week. Let's be honest. But with the big bounce on Friday, my point of view is that this is still a very bullish weekly chart. Now, that conversation comes to an end once we start closing under that weekly 21. And it was looking like, all right, here we go. Yeah, this might be a total shift of momentum for tech stocks here. Still might be, but the big bounce on Friday, it did save it for the time being. Get the close above the 21, stacked moving averages still in place, green 10x bars are still in place, and I've been of the mindset here that potentially we're watching one of the best dip opportunities of the year taking place with a strong market pulling back to the 21, or we're going to see a total shift of momentum. These are things that we just can't answer just yet. So we'll see what this week brings. But man, I'm telling each and every one of y'all, just be patient. It's the first freaking week of March. We got a long year ahead of us. And for many of us, I hope we got long trading careers ahead of us. We don't need to be in a rush here. So I love Google. I think Eli Lilly looks awesome, though it's not the most exciting, sexy name in the world. But do these kinds of setups matter as long as we have the volatility spiking and the indexes are under their 21? These are things we got to be patient enough to see if they unfold. So my focus for the week here, mainly for me at this point, gang, I'm having some fun with Amazon. I really am having some fun with Amazon. So I still have March expiration. So we got about a couple weeks left and an April expiration put credit spread. And the short strikes on those spreads, as y'all know, are down at 3,000. The big 3,000. I got short strikes at 3,000, and I got short strikes at 31.50. And make sure y'all peep the Friday recap video, because I handed out a little bit of tough love. Here's my thing. If you've had put credit spreads in Amazon for the last couple of weeks here, trying to get positioned for this weekly squeeze, you just had 3 weeks of nothing but downside opportunity to cover your ass in trades the opposite direction. And that's what I've been doing is, I'm going to hold on to those put credit spreads. I'm going to take the hit for now, but I'm not going to, roll over and die. If the market wants to roll over, bring it on. I'm going to sell call credit spreads on every bounce back to the 8, and I'm going to keep on rinsing and repeating until ultimately, and where I'm at right now is I've covered a good portion of the max potential loss on the put credit spreads. So if Amazon just continues to roll over here, this whole endeavor might turn out to be nothing but a big scratch, which that's certainly better than taking significant damage. If Amazon, and we look at a weekly chart here, right? If we have put in the bottom, in the last couple of times we have put in the bottom here, and you did see a big ass pump followed shortly after. If we do hold up here and Amazon does make a bounce back and I'm able to get out of those put credit spreads for some profits, then this whole weekly squeeze has just been one big ass home run. We got some nice profits under our belt on that first push. We're making some great gains on the call credit spreads on the weakness, pocketing those profits. And if we bounce back from here, this might be pretty sick. But, proper position sizing is everything. If you've got 70, 80% of your account on Amazon, you're sitting here like a deer in the headlights, totally helpless, totally, helpless and hopeless, watching this come against you. Where there's another trader out there who might be long Amazon just like you are, but they don't got their head in the sand and they're saying, ooh, this is ugly. Let me take advantage of some of this ugly. So Amazon has been just an interesting trade all year long, a lot of good lessons. I'm looking forward to covering those in more detail, but that's going to be the focus this week. If we do see a bounce for tech and we're back to business, hey, let me get those profits coming back from the put credit spreads. If not, you want to keep rolling over here, I'm just going to keep on selling the snots out of some call credit spreads, doing my job, covering that risk. So, major things to pay attention to this week. Does the volatility index keep being a pain in the A, or do things die down here? And that's the first good step. So all eyes on volatility. However, until the indexes are closing back above the 21, it's a big old game of reversion to the mean. So use that as your compass. Google, you look like a rock star right now, Google. But if VIX keeps pumping, market keeps dumping, Google here probably ain't going to do all that much in our favor. So be patient, y'all. I'll keep you posted throughout the week. Till then, trade safe. If you haven't already, go ahead and subscribe, and I will be talking to each and every one of y'all soon. Peace out.